Hey guys, this is AI Mike Zlotnik, not the real Big Mike. Thanks for watching. I love sharing what I've learned about real estate investing over the years, and I'd like to keep you in the loop. Subscribe to the channel for more of my take, and if you want to see the deals we're working on, head over to tempofunding.com.
Hey folks, this is Mike Zlotnik, Big Mike, and today's discussion is all about finding high quality income in real estate today. So high quality income simply means getting predictable, reliable income today and many quarters and years to come. So we'll discuss two primary strategies. First of all, it's going to be a debt investment strategy where you can invest into a lending fund, hard money lending fund, private credit fund. And then the second strategy where you can invest into an equity, conservative, deep value, low leverage or conservative leverage type of syndication, equity investment. And you could also participate in similar funds on the equity side too. But generally speaking, on the debt side, when you're investing into a loan, it's difficult to invest small amount of money into a single deal. That's why the funds, lending funds, become the primary way how most investors participate in a lending side of the real estate business or real estate investing. And you could certainly buy individual promissory notes. It's a possibility too. But it's harder to do. Number one, you have to source these notes. You have to be sort of semi-active versus being purely passive. And you don't have enough diversification. Now, on the equity front, you can actually diversify through multiple smaller checks into multiple syndications, or you can pick a fund that does this for you. So let's kind of dissect what kind of income you can receive, what are the risks. It's very important to look at the risks as well as the rewards. It only makes sense, again, going back to Warren Buffett teachings. The value is what you get, the price is what you pay. So you're looking to get a great value for the price that you pay at the end of the day. So on the income front, most of the conservative funds that I have seen, and again, there are many funds out there, typically generate yield. Again, lending funds, hard money lending funds, private credit funds, they're relatively defensive in nature. Most of these funds that operate without leverage, very, very important point. The moment a fund has leverage, it increases risk. It's no longer that you're in a first position. The lender to the fund becomes the first position. Investors in the fund that give capital into the fund are now in a second position. Very, very important difference. So if a fund offers returns at a higher level, just be aware of how the fund is structured and whether it has debt leverage or a line of credit, securitizing against the portfolio of loans. Now, if you're investing in a debt fund without leverage, returns of 9 to 11% today are the norm. That plus minus a little bit. Some funds pay a little less, some funds pay a little more, depending on the lock-in period, depending on liquidity options. It's possible to get a little bit lower, a little bit higher yield. But that 9 to 11% range, maybe 9 to 10 to be on the conservative side, is absolutely the right ratio. Now, what will happen when the interest rates come down? The chances are some of these return will get compressed a little bit too. So as the Fed continues to cut interest rates, it's possible and likely that the returns in a lending environment over time will come down gradually as well. If you look at the equity investments, so on the equity side, and by the way, let me just go back to the debt side. So most of these private credit lending funds that offer hard money loans, they offer on residential property, on fix and flip projects. That's the most typical product underlying the investment strategy. From time to time, some of these funds participate in smaller commercial loans too. So because the bigger commercial loans typically is the bank territory. Smaller commercial loans, hard money loans, bridge loans is where these type of loans participate. Fix and flip projects are a very, very common area where this type of capital dominates. Now, if you go on the other side of the spectrum and you invest into essentially income strategies, but they also have a growth component. The equity investments always has two elements. When you invest in debt, you get the interest and that's what you get. Your yield is your return. Of course, adjusted for a little bit of risk. On the equity front, you get the yield from a cash flow distributions, and then you also get the appreciation. In many cases, it could be forced appreciation. I'll give you some examples of industrial deals, open air shopping deals, sometimes multifamily deals, depending on the obviously project by project. You have ability to actually understand the manager, the sponsor, the operator who you're investing with, just more important actually than the projects that you invest in. You start always with a jockey, then you look at the horse, you look at the deal. So on the equity side, what kind of returns can you get into well underwritten deals? So we've seen deals in the industrial, triple net industrial, typically absolute triple net industrial, very conservatively leveraged, very strongly downside protected. Initial yield or income starts in the 68% range. Then there is significant upside to appreciation. And the target IRR stands for internal rate of return. That number typically represents a compounded rate of return for comparison versus ARR, average annual return. So IRR is always on the same level, IRR versus ARR. IRR generates typically better overall return. So IRR of, let's call it 15, could double your money in 5 years, even without distributions. Versus for the same ARR, it would have to be 20. ARR of 20 would represent no distributions and doubling your money in 5 years, in a matter of speaking. So let's go back to the type of deal. So industrial, open air shopping, these two categories, we've seen plenty of high quality deal flow, bought very well in these market conditions of higher for longer interest rates, discounted valuations and pricing, where you can get initial yield of 6 to 8%, and then you get target returns depending on the asset itself. Could be anywhere from mid to high teens. So in industrial, it's typically more like 14 to 16, because they are lower risk. They're very, very predictable, very downside protected. If you go to open air shopping, there's a little bit more risk because the tenants, it's a mix of tenants. So it's not always 100% occupancy. In industrial, you can often get 100% occupied, single tenant property, high credit quality tenant on a long-term lease. So the returns are, the yield returns are often in the 6 to 8% range. And then the total return in industrial, for example, could be 14 to 16. In the open air shopping, high teens, 18, 20 is a possibility. Just understand everything in the target returns is a projection. And you have to assess for the level of risk, your level of comfort. But what you get is you get actually pretty solid income to start with. And then you get also meaningful upside on a level of risk in today's environment that feels well downside protected. Interest rates are relatively high on a cyclical basis. As the Fed continues to cut and the market adjusts to this cut, it's very possible that these numbers could be outperformed. Simply, they're based on current interest rates. As interest rates fall, equity in commercial real estate typically gets a ton of tailwind on exit. So just consider that from a market cycle perspective, equity, well-bought equity today is generally more attractive than the debt. Now, how do they compare and contrast in relatively cash versus IRA investments? The reason I want to differentiate this is for IRA investments, when you're writing a check from your self-directed IRA, you generally prefer to be in debt to avoid what is known UBIT, unrelated business income tax. When you write a check from an IRA into an equity or a deal, there's a risk of UBIT, the tax related to the leverage. Now, you can still invest. There's an expression, don't let the tail wag the wealth dog. The tax tail wag the wealth dog, in a matter of speaking. So if you find a great deal, you want to invest with IRA money, you certainly can do that, right? But typically, to avoid the UBIT and to get more predictable income, a lot of IRA investors choose debt funds. Some of them obviously take a little bit of a leap of faith and go into an equity on a well underwritten conservative deal. For cash investments, the consideration is this. If you make interest income from a debt fund, it's typically taxed at the highest interest rates. If you invest IRA funds, they're completely tax shielded. If you invest cash into an equity deal, you have depreciation. And today, bonus depreciation is back. So it helps shield cash flow from taxes today and for years to come. So that's a consideration, IRA funds versus cash funds. And then you always have the option of doing debt and you're doing some income-oriented equity with obvious appreciation upside, but getting a fairly decent yield. When you get a yield 6 to 8 in equity with tax deferral versus you getting 10% in debt, as an example, more or less tax adjusted, you may be getting pretty similar numbers. And then the equity upside actually looks a lot more attractive today versus sort of the no upside in debt. Of course, there's risk in everything. Of course, you got to consider your individual circumstances, where you are in your investment journey, and look at what option makes best sense for you. I hope this was helpful. Appreciate your time and attention. If you like this, please click like, subscribe, and turn on the notifications for more videos like this. Thank you.